Welcome. Thank you for joining us for today's webinar. We appreciate that there's a million things that you could be doing right now, and time is ever so valuable for all of us. And the fact that you're spending some of that time with us means a lot. I'd like to introduce you to our team. We are Compass Financial. I'm Karen Stawicki, and my business partner, Samantha Irish, is also my daughter, and Tim Hudson, our amazing wealth manager, and Allie Sapina. Let's not leave her out. She is the glue that holds us all together. Also the one that very likely will be your first contact should you decide to book an appointment with us. Okay, our goal in the next 40 minutes will be to share with you the following. Why taxes may be the biggest retirement risk you haven't planned for, how to calculate the total amount of taxes you may pay on your IRA or 401k in retirement, and finally, whether creating tax-free income from your current qualified plan makes sense for you. So with that, sit back, enjoy, and I'll turn this portion of the presentation over to Tim.
Thanks, Karen. This first chart shows the impact that COVID-19 has had on the stock market. That's a pretty steep decline, and a lot of clients have been concerned about that. Rightfully so, but that may not be the only concern we have to worry about. See, in order to get the economy back on its feet again, the federal government has dumped trillions of dollars in aid and stimulus packages just to help out the economy. In the short term, that may be a good thing, but in the long term, increased spending usually leads to increased debt, and increased debt usually leads for a chance to raise taxes. On March 17th, Treasury Secretary made this quote, "In different times we'll fix the deficit. This is not the time to worry about it." See, we care about your financial future, and we don't want the panic of today to have a long-term effect on your savings. So now Sam's going to talk about a couple things we can do right now to help you. Sam, go ahead.
So let's talk about compromise. When we compromise, we give up something in order to get something else that we want in return. But did you know compromise is one of the foundations of retirement planning? So much of what we do in terms of our long-term finance is based on compromise. Why? Because we want to balance competing needs, and compromise is the way that we work to achieve that balance. Think about your retirement assets. There are likely 3 areas of balance that desire your attention. First, growth and protection. You are trying to balance ways to grow your assets while still protecting them. It's a balance of risk. The second way that you might want to balance is income and legacy. Put another way, many savers want to accomplish 2 goals with their retirement funds. They need to be able to use that income to live on in retirement, but you may also want to pass that along to your heirs in the form of inheritance. The third balance is between the amount of your assets that you'll get to keep and the amount that you'll pay in taxes. For every dollar of asset, how much of that will end up in your wallet once you've paid the tax? First, we're going to look at the balance between growth and protection. A portion of some people's retirement savings are market exposed, meaning that they rely on the stock market for growth. Historically, the market has been one of the best places for growth, so this makes sense. But if you, like most people, have your funds allocated in mutual funds or target date funds, your retirement assets are more likely exposed to the market and its risk. Well, this is what the market has done so far this century, up to the point of the end of last year. We had the tech bubble burst in the early 2000s. We then recovered, and then we had the real estate bubble burst in 2008. We again recovered, and now we're calling that the Federal Reserve bubble. 2 times this century, the retirement savings that you've accumulated have potentially been impacted due to significant market drops. At the end of last year, the market had returned an average of 6.06%. Clearly, the return is a lot lower today with the recent losses that the market has suffered. In fact, if you're looking at the returns from mid-March, that same period of time only returned about 4.5%. As you see, a big swing in the market can wipe out the growth that you've achieved. We are living through a very volatile time in the stock market right now. The great bull market of the past decade has ended, and now it's not clear where we go from here. The flip side of the coin, if you're not willing to take the risk, is to be saving in more stable vehicles. If you don't like the volatility of the market, a portion of your retirement savings can be saved in these common savings vehicles: savings account, money markets, and CDs. However, according to the US Treasury, interest rates have been falling since 1980, and they're near historic lows. So most of these common savings vehicles return very little, and it's hard to grow your retirement savings with the rates that are shown here. So, like many savers, you're faced with what I like to call the saver's dilemma. How can you find the right balance of strategies that offer growth and strategies that offer protection so that you don't lose all of your nest egg? It's about risk and reward, and the exact balance is different for each person. So we've been talking about how you might grow and protect your retirement assets. Now let's look at how you might be able to use them. Here we have our second compromise. This is our second balancing act. Like many savers, you might need your IRA for income when it comes to retirement, but you may also want to leave some of that as a legacy to your children or to a different charity. Here's how you might use your IRA while you're living. First and foremost, there's the income that you need for daily expenses. Next, you'll need to cover your medical costs associated with aging. It might surprise some of you to learn that a healthy 65-year-old couple could spend nearly $400,000 out of pocket on medical expenses in retirement. Now, you may want to be prepared for some unexpected expenses, whether that's a new car or a new roof, so some of your IRA will be used for those. And finally, whatever is left when you pass away will go to a legacy to your heirs. Now, this is where I want to talk to you about longevity. If you live longer than we planned, my goal is to make sure that you're okay. That means that you've saved enough to cover that. But that also means that the balance between income and legacy needs to be adjusted. Now, if you live too short, that adjustment will be a little different, but that's not the plan we're going for. This graph doesn't really represent the funds that you have or the ones that you can pass on to your heirs. It's actually less than what we've shown. And that's because in this example, I'm assuming that you've saved in a qualified account. And if, like many savers, you've saved in that deferred account, you'll have to pay the taxes out of pocket when you access those funds. So if you've saved in a qualified account, the amount of funds that you could have for income, medical, emergency, or even legacy are reduced. And that brings me to my next area of balance. How much of your assets get to go in your wallet versus to the IRS? Sometimes we like to say that you have a silent partner in your IRAs. That partner is the government, because every dollar in an IRA will be taxed when you use it. This is why you may want to be purposeful about how you approach taxes. Before I go on, let me be very clear. I am not a tax professional. The information that I'm presenting to you is information only, and you should definitely consult whoever your tax professional is when it comes to these situations. But we do have something that you need to consider. Let's look at my friend Alan. Alan is 66 years old. Alan wants to determine his total taxable liability in retirement. There are three things that could happen to Alan's taxable liability when he gets ready to retire. First, his taxable liability could be lower. This is the basis of tax-deferred strategy, like a traditional IRA. You defer your taxes when your tax rate is higher during your working years, and then you access the funds when your tax rate is lower in retirement. Some people believe that they'll have fewer expenses, therefore they could be in a lower tax bracket. So that's our option one. The next thing that could happen to Alan is that he could stay in the same liability in retirement. Some people want approximately the same amount of income in their retirement years that they had in their working years. So they believe their tax bracket will stay the same. Now, Alan and his wife love to travel and to entertain. She sounds like my kind of girl. They are season ticket holders at the theater, and they give generously to charity. So they don't want to change their lifestyle when it comes to retirement. So Alan feels like his tax liability will be about the same as it is today. Now that's possible, but there's one other possibility we need to consider. The final thing that could happen is that Alan's tax liability can go up. This could happen for a variety of reasons. So let's take a look at what those are. This is how Alan could potentially owe more in tax in the future than he does today. His taxes could go up in one of four ways. First, he can make more money and move into a higher tax bracket and owe more of his income in those taxes. Now, it's not likely to happen to Alan, but I would ask you, what tax bracket are you in, and will you be making more income in the future? Next, the government could also raise all taxes, meaning that he could make the same income but owe a larger percentage to the government. Remember, in 2018, Congress passed a tax reform that lowered the tax brackets for many Americans. But those individual tax bracket adjustments sunset in 2025, meaning that unless Congress passes new legislation, tax brackets for many of us are going back up in 2026. These are the most common ways people think about their taxes rising, but there are two other ways that I want to challenge you with. The first is by changing tax deductions. Today, if you're still paying on your home mortgage, you can deduct what you pay in interest from your taxable income. But if that deduction wasn't available, your taxable liability would be higher. The second is by expanding taxes. This means making a tax cover more of your income or subjecting it to new things that are taxable. Think Social Security. Now, we can't predict what new or unexpected taxes will be implemented in the future. Some of you may be aware of legislation that passed at the end of 2019 called the Secure Act. This reformed some aspects of the retirement savings. The act made changes to several things, including the age savers must take their required minimum distribution. Previously, it was 70 and a half, but now it's 72. Legislation like this is just another way that the government regulations can impact your retirement savings and how they're being taxed. All of these can be reasonable ways that Alan is concerned about his taxes and how they may not be lower when it comes to retirement. Let's dig in a little deeper. Here is a sample account statement for Alan, which may help you understand how tax-deferred savings actually work. This sample statement might look similar to the one that you received. This is just one of Alan's accounts, but in this example, the account value is $500,000. Now, we've assumed that Alan is 66 years old and that he has a 25% total tax liability. If he wanted to withdraw all of the money from this account over the next few years, he would not actually be able to spend the $500,000. Remember, he has a silent partner, and he would owe 25% of that to the IRS in taxes. So you can say that this account, he actually only has about $375,000 that he can spend. That's the $500,000 minus 25% in taxes. The difference is $125,000 that he's gonna pay in tax. In a sense, this is the debt that his qualified account carries. He owes $125,000 to his silent partner, the IRS. So Alan's confused, and now he's wondering, when should I pay my taxes? Should he pay his taxes now, knowing that his gains and withdrawals will be generally tax-free? Or should he keep accumulating his funds tax-deferred, knowing that he will pay taxes on the withdrawals in the future? One question Alan may be asking himself is, should I consider converting an IRA to a Roth IRA? To determine if he should consider a Roth, let's look at this in a little more detail. Remember, this is a hypothetical situation and it is not investment or tax advice, so please consult the professionals. However, we're going to dig in a little more. We know that Alan is 66 years old and that he has $500,000 in his IRA. Right now, he doesn't plan to use it for income in retirement. He's just letting more money accumulate. He'll pay about 25% in state and federal taxes combined. So we're going to have to make a few assumptions about Alan. So here's what we've decided. First, we assume Alan maintained a 25% tax liability in retirement. Next, we assume that his IRA will grow at 5% annually in the future. When Alan turns 72, he will take RMDs, which will be taxable. Remember, this is because of the Secure Act that came out at the end of last year and it increased the RMD age from 70 and a half to 72. Now, any money not used for income can be reallocated into another financial vehicle where its earnings will be subject to taxes. We're assuming here that he reallocates those into a taxable vehicle, but that's earning 5%. And finally, we assume that Alan will live to age 90. So let's see some ways that Alan's IRA might work based on these assumptions. Here's some basic math. Assuming Alan receives his RMDs per the IRS rule, he'll pay about $158,000 in taxes on those RMDs. Because he didn't need the RMD for income, we are able to reallocate those funds into another financial vehicle. And he'll need to pay taxes on the end based on what is earned, which in his case is a little over $69,000. Finally, when Alan passes away, his heirs will pay around $110,000 on the remaining account value. Remember, in this model, the Secure Act is requiring Alan's heirs to liquidate the IRA over the 10-year period. So Alan has $500,000 in his IRA today, and potentially over his lifetime, that IRA could generate around $338,000 in taxes. Now, Alan's other option would be to consider a Roth conversion for his IRA. In a Roth conversion, Alan would go ahead and pay the taxes up front. Now I know that's a big swallow, but let me show you how those funds would accumulate tax-free going forward. In this hypothetical situation, Alan would go ahead and pay $125,000 of taxes from his IRA. In the future, he wouldn't pay any taxes on the IRA growth or the remaining IRA when he passes it on to his heirs. So in this example, Alan's IRA would potentially generate $125,000 of total tax. So Alan's faced with a choice, and this is the choice that most of you have as well. According to the assumptions we've made, he could possibly pay more than $338,000 in taxes in just that one IRA. Conversely, he could consider paying the $125,000 in taxes up front if he converts it. Now keep in mind, this presentation is not given a complete representation of all of the features and benefits and the requirements of the two strategies. But your tax bracket could be higher or lower in retirement, and we want to be able to address that. I know I've spent a lot of time discussing taxes, but it's really an important consideration. Too often we consider how your account will grow, how you'll spend it, but we don't take as much time to consider how much of those funds you actually get to keep and how much will go to taxes. And if you, like Alan, have multiple accounts, those two numbers actually grow by that multiple. There are two ways we consider taxes when assisting you in retirement. The first is through a micro-tax lens. The goal of this approach is to minimize the amount of tax that you pay today. This approach is why so many people choose to save in tax-deferred accounts. You get a tax deduction for the funds that you contribute, lowering your overall taxable income for the year. However, the other lens that we need to take into view is through a macro lens. This approach aims to lower your taxes over your entire lifetime, not just today. As we say, begin with the end in mind. So I like Alan, but Mary is a little more my speed. For this example, we'll assume that Mary is in the 33% tax bracket when you combine state and federal. She's been contributing $10,000 annually to her tax-deferred 401k for the last 30 years. We've assumed that she's gotten a 7% net annual growth on that account. As you can see, Mary deferred $3,300 annually for 30 years. That's a total of $99,000 of deferred tax. Sounds pretty great. But now that Mary is retired, she still owes those taxes that she deferred. If Mary wants to withdraw $50,000 a year in retirement, she'll pay $16,500 of that in tax. Now, let's say she does that for 30 years. Mary will now pay nearly $495,000 in tax. Now on the upside, Mary's 401k contribution limits were higher than that of a Roth or traditional IRA, but she still owes tax on all of that growth in the retirement account. So let's look at what that means in terms of deferring taxes. She deferred $99,000, but will end up paying $495,000. That's almost 5 times. I'm not sure that it worked quite as well as she had hoped. I started this presentation talking about compromise. Compromise is important as you balance the competing interests of your retirement assets. In my opinion, the biggest areas of compromise are around balancing growth and protection, income and legacy, and the funds that you spend versus the funds that you have to pay in taxes. I've only discussed one of the tax-free options today, but there are a few. And when determining if this is a good option for you, you need to understand what works best for your individual situation.
Thanks, Sam. That was great. Hey, if any of the things we've discussed today resonate with you, if you share some of the same concerns as in our examples of Alan or Mary, we'd like to offer you an opportunity to talk with our team. We believe there are several ways we can actually help strengthen your financial strategy for retirement. First, if you're curious to see what the total tax liability in your current IRA would be, we can run that tax analysis for you, like the example Sam shared in the presentation. Second, if you'd like to consider how your current IRA or 401k may accumulate and what those RMDs would look like for you in the future, we can provide a projected RMD analysis. And finally, if you're interested in alternative or supplemental approaches to accumulate retirement and legacy assets tax-free, we can show you some customized solutions for options that might help you in that area. The bottom line is, we would be honored to help you review your current situation, find out your financial goals, and then help you secure a strategy that can give you more financial confidence in retirement. But you must act now. We've been saying a lot lately, let's make lemonade out of these lemons. You see, there are many opportunities that suddenly are presented in light of our current situation that we want to capitalize on now before we miss out. Now, each person watching this webinar today will receive a follow-up email. In that email will be a link for you to click on and schedule some one-on-one time with us to review your personal situation. Now, on today's webinar, we clearly have a limited amount of time. It's obvious we can't cover all of the strategies to potentially help you address the compromises we've outlined today. However, we can discuss them and your personal situation on an individual call or meeting. As a thank you to each of you for your time today, we'd like to send you a copy of one of our favorite books, the No Compromise Retirement Plan or the New Rules of Retirement Savings, both of which discuss the ideas of creating retirement income that works for you and not the IRS. I would really encourage you to read it. It's short and totally worth your time. As the quote says, there are two systems of taxation in our country, one for the informed and one for the uninformed. Your financial future is important. We don't want to let the panic of today leave you unprepared for tomorrow. Don't be the uninformed. Schedule your appointment today.
Hi again, it's Allie. I'll be sending that email out shortly, and we look forward to spending some one-on-one time with you.
Thanks again for joining us.
See you later.
Bye.